Let's jump into problem 618, inventory purchase discounts. I hope you haven't forgotten, but a lot of companies offer these early payment terms, 210 net 30. It means if we pay within 10 days, we get a 2% discount if paid within 10 days. Otherwise, we just got to pay the bill in 30. After 30, they're going to start assessing us late fees and penalties, that type of thing. But of course, we're going to pay within 10 days because it makes economic sense to do so. The following transactions occurred for May Inc. Purchased on April 3rd, purchased $10,000 of inventory on account. And there's the terms. And on April 10th, we pay the bill. And it says, do the journal entries. Okay, so April, not 30th, 3rd. What happened? We bought some inventory on account. We debit inventory $10,000. And we credit accounts payable $10,000. Good for us. We bought some inventory. Now, what happens on April the 10th? Well, on April the 10th, we pay. And the question is, how much do we pay? And the answer is we don't pay the full 10 grand because we're going to take our 2% discount. So what does that look like? Well, 2% of 10,000 is $200. We're going to take a $200 discount. So we're not going to pay 10 grand. We'll pay 9,800, right? 2% off. So let's credit cash. Let's see. Maybe I'll zoom out just a touch here. Let's credit cash for 9,800, the amount we're going to pay. Now we got to think, well, what happens to this payable? And the payable, of course, is reduced. It was a $10,000 payable. We don't owe these people anything, so our payable's got to go to zero. So I debit AP by $10,000, and you can see we're off. We're missing a credit of $200. Now, the mistake students make here is they credit discount. And they'll say, well, this is the discount. Let's credit an account called discount. You'll do that as the seller. As the buyer, you don't. As the buyer, you credit an account that the first time you see it, you're like, really? Credit this account? Does that make sense? I'll explain why, but the first time you see it, you'll be like, no, that seems a little weird to me. We credit inventory. So that's it. We've solved the problem. This is correct. But let me explain that credit to inventory by showing you the inventory T account. Oh my goodness, inventory. It looks like inventory. Let me change that. There we go. Now it looks like inventory. Okay, so I've got my beautiful inventory T, and you can see I got a debit of 10,000. I just credited it by 200. So what is my inventory worth? My inventory is worth $9,800. That makes sense. Why does it make sense? Because that's what I paid for my inventory. When you buy an asset, the value of the asset is what you paid to make it useful. We didn't pay $10,000. So to report this inventory as 10K, which we would have done, right? If we didn't do this credit, our inventory is just on the books for 10,000. That's wrong. We only paid $9,800 for this inventory. That's the value of our inventory. So you don't get to include the discount. So in other words, if you go to a car lot and you want to buy a truck and the truck price is $80,000 and you negotiate and you get it for 70, you don't get to go debit truck 80 and, oh, I got a $10,000 discount. No, it's a $70,000 truck. Well, this inventory, the true value of the inventory is $9,800. Why? That's what we paid for it. Brings up the quirky situation where if we just waited another week and paid on April 17th, this inventory value would be $10,000 because that's what we would have paid for it. We didn't claim the discount. So it's the exact same piece of inventory. It could be worth more if we paid more. So it's a funny situation, but there you have it. Our inventory is worth what we paid for it. It's worth $9,800. As always, hope these videos are helping, and I'll see you in the next one. Bye for now. The next video in our series is right up here, and if you want a supercut of all of the videos in this series, that's the one down below.